Good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of Looking Ahead to 2018, Anticipating and Preparing for Next Year's Market. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, along with John Schlitz, Chief Market Strategist at Chaikin Analytics. Throughout our presentation, please submit your questions using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. As a reminder, this webinar is being recorded and a copy will be sent to everyone who is registered. To get us started, here's Marc Chaikin.
Thank you, Joe, and welcome everybody. This is the third year that John and I have done a look ahead prep and also a look back on the previous year, and it's a pleasure to keep the tradition alive. Many of you know me as a technical analyst. 8 years ago, started Chaikin Analytics with the goal of building a predictive model that went way beyond technical analysis, that incorporated the fundamental factors that successful institutional investors look at every day before they make decisions, and that resulted in the Chaikin Power Gauge rating, which we'll be talking about on this afternoon's webinar. With that, I'd like to introduce my friend and colleague, John Schlitz, who has worked with me for over 20 years. So John, why don't you give the folks a little bit of an intro.
Okay, Mark, thanks. Good afternoon, everyone. Like Mark, I have a technical analysis background. I started many years ago at Lehman Brothers on the equity trading desk and then became the technical analyst for the entire equity trading floor. And then I teamed up with Mark about, 20 years ago. And my experience is basically with dealing with institutions. So I'd like to think that I bring sort of an added dimension of, why the markets move, how they move, and how the institutions think. And hopefully that comes through in the morning commentary.
Thank you, John. We'll be talking in the next 45 minutes, that might stretch out to an hour, about how to prepare yourself for 2018, but we'll start by looking at 2017, recapping and reviewing what we learned, and then we'll look ahead at 18. And most importantly, we're going to zero in on how you can find the sectors, industry groups, and stocks that are going to do well in the new year, and also how to avoid losers, because playing good defense and protecting your capital is going to be very, very important here in 2018. This graphic, I think, tells us pretty much everything we need to know about 2017. We've been in a worldwide economic expansion with accelerating growth here in the US in the third and fourth quarter. As we'll see later on, the price of oil has rallied dramatically, but we're still plagued with headlines day in and day out about the potential collusion of the Russians in the US election, and we're dealing with President Trump and his agenda and also his tweets. And finally, and most importantly here as we head into year end, whether or not a Republican tax reform bill is going to get passed. Today, the markets were somewhat volatile when there was a bit of a shouting match between the Republicans in the House and the Senate regarding the new provision that got pushed into the Senate version of the bill, bringing back the alternative minimum tax. So that's pretty much what drove the market in 2017. And this is a chart that we showed in last year's recap. We felt that 2017 would see higher interest rates, which they did in the main, and rising earnings, and that's a bullish scenario. We also think that's likely to be what happens in 2018, as John will tell you when he reviews the slide of interest rates. We may see increasingly higher rates in 2018, and that would actually be bullish. So before we start the presentation, I'd like to do a little poll, and the question we'd like you to answer is whether you're thinking about a bear market. Are you anticipating that there's a bear market coming? And Joe's put up a poll here. If you feel bullish about the market, check that box. If you're bearish, it's right underneath, and uncertain if you really don't know what's coming.
See, there's already a lot of responses coming through. Thanks in advance for all of those. And we'll give you a few more seconds. All right, and let's take a look at the results. Most looks like 45% I'm bullish, 38% uncertain, 17% I'm bearish.
Well, this means many of you may be reading our market insights or John's morning insights, because we've been bullish and we're maintaining that bullish posture into the new year. Interestingly, when we did this poll with a partner who is a fabulous macro analyst and has been quite bearish for the last 6 months, a lot of his community was on the poll and 51% were bearish. What that tells me is that we're very influenced by the people that we respect and that we follow, and to some extent by the talking heads on CNBC. So we're going to try and debunk some of those myths as we go and look at the market. So the first thing I'd like to look at is the S&P 500 index. I'm going to start this out, but I think, John, once I'm through with my comments, I'd love you to comment on it. This is a 5-year chart of the SPY, so this is the large cap S&P 500 index ETF. And prior to 2016, we had a pretty straight up market with what we call V-shaped bottoms. Every decline was met by buying, therefore you heard on CNBC, buy the dips. And then in 2016, in August and then February, we had what we call a W-shaped bottom. And that W-shaped bottom turned around in February of 2016. And we've pretty much been straight up ever since. We've only had one decline of 5%, and that was right before the Brexit vote in June. And then we broke out above this long-term quadruple top formation, and so many people feel that a new bull market began there. You did have a bear market, as we'll see, in energy stocks and in small caps in 2014 and 2015. So John, what are the implications of breaking out if in fact we actually have started a new bull market here, as opposed to being in the final stages of what some people are calling an 8.5-year bull market?
Well, I think, first of all, the most important thing as a technician that I'd like to point out is how powerful long-term breakouts are. When you have a pattern that's almost a year in the making, and then you consolidate near the top end of that range, you can really start to raise the odds that that you're going to get a positive resolution. But more than that, these long-term breakouts, and we'll see a little later with some individual stocks, they really carry a lot of weight. You not only get short-term traders jumping on the bandwagon for a quick trade, but this is the type of situation where you get longer-term. They're most likely they're fundamentally oriented, but this is where you very often see fundamental portfolio managers gain a higher degree of confidence when they see these long-term breakouts. And that often results in bull moves that tend to exceed their target counts. And in this case, the target count was around 240, and it actually went straight to 260 with very minimal pullback. So longer term, what that suggests is that you normally don't see legs like this as the last leg of a bull market. They're usually somewhere in, leg.
I think we lost John's sound. Hopefully he'll get it back, but I'm going to move on to the next slide. So let's take a look at a 1-year chart of the S&P ETF, the SPY. And as you see, we were in a pretty well-defined trend channel, and we broke out of it last week as the market fulfilled our long-term price target of 2650 on the S&P. And we were down today across the board. Small caps gave up some of their gains. NASDAQ continued weak, and we had, a 3-day pullback here in the S&P. So why are we still bullish? Well, Chaikin money flow is very strong. many of you know this from your online brokerage platforms or stockcharts.com. It measures institutional buying and selling, and institutions use the SPY as a way to get instant equity exposure when they want to be long the stock market, but before they've figured out which stocks and sectors they want to own, they'll buy the SPY if they're into the large cap names. And so this is all very strong. We have something that we call our power bar, which looks at the number of stocks with bullish versus bearish ratings, and that's very, very positive for the SPY, not so much for the NASDAQ. But I'd like to bring you back to this red caution signal here in March of 2017. The S&P 500 was around 2350, and as we'll see in a couple of slides, there were a lot of bearish commentators around at that point. So before we move on to that, let's take a look at the NASDAQ, which has been leading the market higher. Starting in January, the NASDAQ on our proprietary relative strength indicator here at the bottom of the chart went from red or underperforming the S&P to green or outperforming, and it's maintained that outperformance with strong Chaikin money flow the whole way. It's correcting now. Why? Because the tech stocks are correcting. So it's possible that the NASDAQ could sell off another 1 to 1.5% here by mid-December before we get a big year-end rally, which we're anticipating. Now, here's what the various indices have done over the last 12 months. The NASDAQ 100 has led the pack, almost a 30% gain. Tech stocks are up over 35%. The Dow, which is only 30 stocks, up 27. The S&P 100 up 20. The S&P 500 19.68. Year to date, I think it's 17.6 because this is a 12-month rolling performance. And then at the bottom are small caps and mid cap stocks. So they've been underperforming, and we think that's probably going to be reversed in 2018 and perhaps in the latter part of 2017. So large caps have dominated, particularly in the S&P 500. The big FANG stocks, Apple, Amazon, Netflix, Facebook, Google, have contributed a high degree of the percentage gain in the S&P. So it's been a good year for stocks, but in spite of our bullishness, if you're still maintaining a bearish point of view, if you want to hedge a portfolio, here are two ways that you can do that. Using our options play idea module, you could bet on an 8-point drop in the S&P, which is roughly 3% by January 19th, by buying what's known as a vertical put spread or a credit spread, a debit spread rather. And you do this by buying the 265 put. This was this morning when the S&P was still up a little on the day, and selling the 257 put against it. That expires on January 19th. So if the market were to drop 3%, as a speculator, you could make a 245% return. Your total risk per spread is $232. Or if you have a 401k plan or an IRA that has $250,000 in it, you could buy 10 of these spreads as an insurance policy, $2,320, and ride that crest, as John said, if there's more to come in the market, knowing that you're protected for 3% on the downside. Now on the right are the power shares QQQ and a spread that you could put on in the NASDAQ 100. In this case, you'd be betting on a 5% drop, and you realize a profit of 284% if the NASDAQ drops 5% by January 19th. Again, these aren't recommendations. They're just suggestions of ways that you can profit on the downside if you're bearish, or protect a portfolio. So if you've got a portfolio of primarily tech stocks, this spread costs you $205. Let's say you own $250,000 worth of tech stocks. You buy 15 spreads, $3,000. You protect that portfolio, and you can ride the crest of tech's rebound, as we think they will, toward the end of the year. Now, let's look ahead to 2018 and what you should be focused on. First and foremost, the trend of the market. We see that the trend is still up. One very simple way to measure the trend is a series of higher highs and higher lows, and that's what we've seen in both the NASDAQ, the S&P 500. You should look for pullbacks as buying opportunity. We had none in 2017, as we'll see. I expect that we will in 2018. You want to be monitoring the trend of corporate earnings because earnings drive stock prices, and the effect of the tax cut if it's passed on corporate earnings. And we'll give you an insight into that in a minute. And then finally, it's very important to identify strong and weak sectors and industry groups because that's where the real money is made. Buying the strong sectors and industry groups and avoiding the weak ones. Now, volatility is not a recent phenomenon, but it disappeared in 2017. Each year, the markets have typically experienced a significant correction. Over the last 30 years, they've averaged 14%, but that incorporates a couple of bear markets. Typically, those who stay the course were rewarded. The markets came back. But 2017 was different. There was no pullback of 3% or more in 2017. So the question on everybody's mind is, when are we going to get that pullback? And I wish I could tell you I knew, but I don't. But I think we will see a pullback in 2018 of 5 to 10%. So let's put pullbacks in perspective. Typically, and this goes back 72 years to 1945, roughly once a year you get a pullback of 5 to 10%. The good news is these declines are fast and furious. They last a month, but then it takes only a month to recover. Now, if you look at the bottom, which are the bear market categories, 20 to 40% drops, there have only been 11 of them in 72 years. So roughly once every 6.5 years. The takeaway for me from this slide is pullbacks are your friend. And if you're constantly looking for a bear market around the corner, you're going to be missing a lot of opportunities. So here's a different way to look at 2017. It's been a low volatility year, and we've been up from day one. There have only been 10 years, going back to 1943, where you've been up every day of the year. And in 9 out of those 10 instances, the market was up the following year, an average of about 12%. So we're going to end 2017 on a similar note. In fact, we just finished November. It's the 12th consecutive up month. And it's been a very low volatility environment, as I said, with narrow trading ranges every day and no pullback of more than 2.5%. Typically, when that happens, you do see a pullback of 5 to 10% the next year. So when I add all that together, I'm thinking we're going to see a pullback of 5 to 10% at some point in 2018, but the year should end up on an average up around 12%. That tells me I want to be buying pullbacks. I want to be looking for good stocks in strong sectors and industry groups to buy on a pullback next year. Now, why is the market likely to be up next year? Well, as we'll see, earnings drive stock prices. And we've been chugging along with about a 2.2% annual GDP growth since the bear market ended in 2009. That's now accelerating to 3%. Third quarter indicated 3% GDP growth. Fourth quarter estimates are for 3% plus. So the economy is accelerating. Here's another way to look at that. These are the earnings estimates going back to 2008 from FactSet for the S&P 500. And it shows that in 2017, the S&P on average is going to earn $1.32. That estimate in FactSet is $1.46 for 2018. That factors in a part of the tax cut increase. It would be $1.41 without that. And then again in 19. So earnings estimates are positive for 18 and 19. Hard to know what 19 is going to bring, but that 18 estimate is probably pretty factual. So I'm going to implore you to ignore the headlines, because there's always someone who gets quoted who is telling you, as this headline did in the New York Times, in that March period that we highlighted with that caution sign, caution signals are blinking for the Trump bull market. This was March 31st. The S&P was 2350, 2360. It's now over 10% higher. So please ignore the headlines because earnings move markets. So if you can identify the trend of the market, trend of corporate earnings, find the strongest sectors and industry groups, then focus on stock selection. We're going to end the webinar by showing you our favorite bullish patterns and how you can spot them, and also give you John and my watch list for the first quarter of 2018 on both the long and the short side. So please stay with us. Now, it's important to note what the impact of the corporate tax rate cut is. There are over 1,000 stocks in the Russell 3000 index with a corporate tax rate of 30% or more. If the corporate tax rate drops to 20%, that's a major boost in earnings. In the S&P 500, if that happened all in 2018 and the Democratic, the Senate bill rather postpones that to 19, so it may be that there's a split. But if that happened, it would add $10 to the S&P 500 earnings. In this screen, what I've done is we put in a user list called tax rate 30% that you can access in Chaikin Analytics. And I've screened for just small and mid-cap stocks who are likely to be the biggest beneficiaries with a 30% tax rate and a bullish power gauge rating. There are 311 of them because I didn't apply any other filters. But this is your fishing list. This is your potential buy list, your shopping list, if you will. And there are a lot of familiar names on there, stocks that have done well in the financial space, stocks in the tech space that pay a high tax rate. So any company that pays a high tax rate, has a bullish rating, generating positive cash flow, is a potential beneficiary of the tax bill. Now, even the best investors get it wrong. So to go back to March, April of 17, here's a quote from Paul Tudor Jones, arguably one of the most successful hedge fund managers ever. What he said back in April was, stock market valuations are terrifying. And this reporter said he's right. So Paul Tudor Jones emerges as the latest mega bear. Well, the market is up 10% since then because valuations don't cause bear markets. And they're reasonable. In spite of what you're hearing on CNBC, valuations are reasonable. Why? Because this chart from FactSet and Charles Schwab shows that when inflation is in the 2 to 3% a year range, where we are right now, the average price earnings ratio is 17.6 on the S&P 500. If you ascribe a $10 benefit in the S&P 500 in 2018 from a 20% tax rate, and this is a little speculative because it hasn't passed yet, the S&P 500 earnings would be 150, and that equates to exactly a 17.6 PE ratio based on where the S&P was today. So the market is not overvalued when you factor in the tax cut. Even without the tax cut, we're way better than the highest PE when the inflation is where it is. So valuations don't cause bear markets. Here's another thing that doesn't cause bear markets: unsettling political events in the US. Over the last 50 years, we've had a number of them. They do not cause bear markets. We'll just zero in on two of them. The assassination of President Kennedy in 1963, the bull market resumed within 2 days and lasted for another 2.5 years. And then the impeachment proceedings against President Clinton in 1998, bull market just kept going for another 2 years. So political uncertainty and upheaval does not cause a bear market. So please don't confuse your political views with your stock market strategy. And we'll end this piece of the webinar with two indicators that have reliably preceded every recession since 1960. And recessions and bear markets go hand in hand. 12-month moving average of housing starts has always turned down significantly before a recession and therefore before a bear market. It's now re-accelerating to new highs. October numbers were off the charts, and the ratio of leading to coincident indicators released by the Conference Board, very easy to see, it's quoted in the Barron's every time it's released, making a new cyclical high for this bull market. So the two most reliable indicators of a bear market and therefore a recession are nowhere near concern for investors. So stay with the trend. As long as the earnings come in as expected, the trend is your friend, and we should see a bull market. Now, we've talked about an awful lot of different things, economic statistics, earnings, option strategy to hedge your portfolio. When I sum all that up, it's information overload. There's just too much information. And you've got to have a way to cut through the clutter. And for Chaikin Analytics and our members, it's the ability on one screen to see everything you need to know about a stock to make an informed decision, including an option strategy like we saw with the index options. Now, along the way, we've been quoted in the media, embraced by some of the smartest traders and investors like John Najarian and Jim Cramer, and some of our old institutional clients who John used to talk to on the Instinet trading desk as well as the Lehman desk, Fidelity Investments, Soros, Paulson Hedge Fund, are using Chaikin Analytics. So there's a lot of endorsement of the power gauge rating and what we're going to be teaching you in the balance of the webinar from pros who've been successful in the market. Now, Chaikin power gauge rating is displayed as a gauge, looks like the gas gauge on your car. It's meant to be simple, but not simplistic. It's very powerful because under the hood, there's a lot of number crunching going on. We take all that data on the right, the fundamental data that professional investors look at, successful investors, and distill it down to a gauge like the one for Lam Research on the left. And I have a hard time taking this out, even though that gauge goes back to March 27th, because Lam Research, which had a very bullish rating then, went from 127.80 to a high of about 210, 220 before this recent tech correction. So we cut through the clutter and make it easy for you to spot the potential winners. And here's an example of that. This is just sort of a taste of what we're going to be showing you at the end of the webinar. This is a one-year chart of Cigna, health insurance company. Power gauge rating is at the bottom. It's been bullish for over a year. The stock has moved from about 130 in the last 12 months to a high of 210. This was a pretty easy stock to own, and these are the stocks that you want to try and buy on dips, pullbacks in the market or in the stock itself, and then hang on to if you're an investor, or trade for swing trading purposes if you're trading in that 2 to 4 month time horizon that swing traders sort of like. Now, the power gauge rating is composed of 4 primary components: value, growth, technicals, and sentiment. Within each of those, there are 5 factors. Not going to get into the factors today because this is all about next year, but I will tell you that the most successful institutional investors look at these factors every day. They don't all look at every one of them, because you have value investors who look at free cash flow and price to sales ratio. You have aggressive growth investors who are looking at the growth factors and earnings surprise. And then sentiment, which is our secret sauce, is what a lot of the pros, so it encapsulates what the pros are doing. Short sellers, insiders. What are analysts doing and saying? John, have you gotten your sound back?
I think so. Can you hear me?
I can. Anything you'd like to add about the factors in the model, because you've been working with them for 4 years now and know what the institutions look at?
Well, all I can say as a technician is that if you're not really familiar with how to take that information and actually distill it down to something that can help you make an investment decision. That's really why having these gauges and the power gauge and the individual sliders is so important, because it gives someone like me who doesn't focus on these things an added degree of confidence, because assuming I believe in the track record of the power gauge, which obviously I do, when I'm doing my technical work and I see, for instance, a breakout, and we'll have an example of it later, when I see the breakouts or trend reversals or any type of technical signal that is confirmed by these indicators, it gives me a much higher degree of confidence on being successful on that trade. And it's a world of difference versus just doing basic charting without any of that input.
Yeah, I think that's really a key point. If all you're doing is looking at the technicals, you're basically trying to monitor or track the fundamentals through price action, because usually, but not always, price action mirrors the fundamental thinking of the major Wall Street players. But if you have something you can rely on that summarizes the potential of a stock to outperform the market, or as we'll see, underperform, that really gives you what we call the directional edge. Technical analysis can confirm that and project strength or weakness and price targets and so forth, but we think the power gauge rating gives you that directional edge. Helps options traders, helps investors. And when we look at how you can spot what stocks to avoid, then you're really putting the odds in your favor. So a little bit of performance data. In 2016, the average very bullish stock in the Russell 3000 in the Chaikin model up 32%. Average very bearish stock up only 9.5%. This year, the average very bullish stock, when we finish December, is likely to be up about 22%, so more than the S&P. And some of the bearish stocks have actually done well because energy stocks have turned around and the ratings are now sort of mixed on energy. So the very bullish stocks still outperforming the market in 2017. In 2015, when we actually had a bear market in energy and small caps, the very bearish stocks in the power gauge rating were down 17%. This is part of the reason that I created this model, because it's hard to sidestep those, as we'll see when we look at diamond offshore. And people are prone to bottom fish, and bottom fishing is pretty dangerous to your health. And we'll see why and how the power gauge can help you avoid the temptation to buy into a stock early until you know that the fundamentals have actually turned around. So we think what's most important and what we want to focus on here for the next 15 minutes is using sectors and industry groups to find winning stocks and allocate your trading or investment capital properly. So strong sectors and industry groups give you a tailwind. Research has shown from Zacks, from Investors Business Daily, from Standard & Poor's, that strong stocks and strong industry groups tend to outperform the market by a wide margin, and weak stocks in weak industry groups basically give you headwinds that are hard to overcome. John, what's been your experience with group and sector analysis over the years?
Well, without as a technician, you can only get so far. I mean, we use relative strength extensively, but that can only take you so far. So and it's at the risk of being repetitive, when a technician can take the simplistic relative strength trend reversals and add on top of that our relative strength model, which incorporates persistency as well as the current readings, it gives a whole new insight into whether these price moves will be able to continue or not. Because Mark, as you know, in the back test, it's the persistency ratings in addition to the current ratings that really produce the extended price move, not just the short-term movements.
So let's see some examples of that. We have a unique way of looking at the strength of sectors and industry groups. We obviously look at the price performance and the relative price performance that John was alluding to. But we also have something that we call the power bar. It's the number of stocks with bullish versus bearish ratings in the Chaikin power gauge methodology. And we rank them. So here we're ranking the 10 select spider sector ETFs. This is the large cap universe of the SP 500 carved up into 10 sectors. And right at the top, financials, utilities, which I view as an outlier for people trying to find higher yield in a low interest rate environment. Healthcare, technology have been in the forefront, and energy had been at the bottom from late January through just 2 months ago, as we'll see. And now we've got 7 bullish rated stocks in the energy sector and 5 bearish. Those bullish rated stocks are all in the refining and exploration area. It's still the offshore drillers and the equipment manufacturers with the bearish ratings, as we'll see. So let's drill down on a couple of these sectors. But before we do, look at the sector performance over the last 12 months. There's technology up over 30% for the year. These are large cap tech stocks. Financials up 25%, materials up 20%, and at the bottom, energy down almost 5%, real estate down up 10 only, consumer staples 11. If you want to outperform the market, you've got to be in the strongest sectors and industry groups. So let's take a look at what a strong sector looks like in terms of earnings. These are the FactSet earnings estimates for next year for the various sectors. Energy, right on the left, a huge projected increase, 36%, coming from a low base. Materials, financials, technology, these are the sectors that are going to have earnings growth projected by FactSet, very reliable source, that are stronger than the S&P. You go to the other side, telecom, utilities, real estate, healthcare, consumer staples, projected to grow at a lower rate than the S&P. So where do you want to be? You want to be in stocks where the earnings are going to be up and they're reflected in the power gauge. That's why financials, materials, and technology have positive power bar ratings. And that's what drives stock prices. Earnings drive stock prices. So here's the XLK, the technology ETF that reflects the large cap technology stocks in the S&P 500. It's been outperforming the market since it had a bit of a correction in December, January after the Trump election. Relative strength has been very strong. It's had a bullish power bar rating going all the way back to January. And look at the persistent accumulation in the Chaikin money flow. John Schlitz has called this stealth accumulation. And John, how do you use this in a sector analysis?
Well, I mean, you can use it the same way as you would an individual stock. When I see a corrective phase, which in June and July was a very typical, what we call a ABC or a three-wave corrective move, you know, if you're just looking at a chart, you're hoping that wave 3 is going to be the end. But when we see this accumulation in money flow or this persistent accumulation, we can put much greater odds on having a positive resolution. And also for the shorter term traders, we're advising, we'll have a higher degree of confidence on putting a long side bet on near the lower volatility band. I mean, without that, we would have to wait as a discipline to connect those 2 peaks in June and then wait for price to break that short-term downtrend and then get in. And by then, you've missed a fair portion of the move.
So what I'm seeing in this chart adds a little bit of color to what John just said. You've had a correction in tech stocks. There's been sort of a rotation out of tech into financials and energy in the last week or so, but yet Chaikin money flow is still very strong. What does that tell me? It says that the institutions aren't really contributing to the sell-off. Might be some liquidation of ETFs. They're actually probably accumulating tech stocks here. Otherwise, Chaikin money flow would be dipping down toward the zero line or into the red. So when you in a situation like that, you want to look for stocks like Micron, which has been one of the leaders in the semiconductor group, which triggered an oversold buy signal coming into today. That's a new 8-day low on a stock with a bullish power gauge rating. Now, when I did this chart, the stock was up 5% this morning. It finished up about 2.5%. So this is exactly what John's talking about. When the sector is strong and the money flow in the sector is strong, you're more prone to take advantage of a buy signal like this, like you saw in Micron today. Now, let's look at the financial sector. Financial sector had been in a corrective phase. Money flow was still green, persistent accumulation since September, outperforming the market. That's our relative strength indicator right here. Here's Chaikin money flow. And you had a big breakout last week when it became more likely that a tax cut was coming, because a tax cut helps the banks. It stimulates the economy in theory in the short term. Interest rates probably go up. That's good for the banks. So you've had a major breakout in financials, and that's something that you want to be aware of because the power bar is so strong. Remember, there were only 3 bearish and about 31 bullish stocks. So John came up with a good explanation for why financials might be strong.
Okay, well, you know, it's certainly an underlying positive. It hasn't, you know, interest rates really haven't helped the sector significantly over the very near term. But as you can see, towards the end of 2016, the 10-year yield broke a very long-term downtrend line. That was very significant. And what increased its potency was the fact that the prior low was part of a major long-term double bottom. So that gave first of all, it raised the odds that we would at least get back up and test the downtrend line. And then it also increased the odds that on that pass, we would get through it, simply because we held the 2012 lows. The ensuing rally went right back to the 2015 highs and then paused. And you can see what's happening. The current dip is tracing out what could be a potential 3.5-year reverse head and shoulder pattern. So at a minimum, we see yields, you know, within the first or second, maybe the middle of the second quarter, most likely testing that neckline up around 270. And, you know, with the additional positives of, as Marc said, the tax plan and lower regulation, this is not necessarily going to make the banks go up, but it's a very bullish backdrop, especially if we get the 3% plus GDP readings with continued low inflation.
Yeah, and the Fed has already told us they're going to raise rates in December, and that there may be another 2 or 3 interest rate hikes in 2018. So if that happens, I guess the 10-year could stay below 270 or below 3. But it does suggest the potential for a move above 3 on the 10-year Treasury, and that's good for the banks. And in general, if we don't go much above 3%, good for the stock market as well. So there's a good backdrop, as John says. And John, we've got 2 slides here for a bank stock that you've identified that's broken out.
Yes, this heavy rotation last week, very aggressive, by the way, both in price moves and in volume. SunTrust broke out of almost a 12-month consolidation phase, and we're seeing this across the board with many stocks. And it's a very bullish situation that we think will, assuming we come back and test that breakout level successfully, which we think the positive backdrop we just laid out will allow to happen, that will continue with these positive moves into the first quarter.
Now, of course, here's a bigger picture. This is that 5-year chart that John loves, and he penciled in the current action, but I drew a trend line on a previous breakout. So, John, what happened there back in 15, 16, and how does that relate to what's happening now?
Well, what happened in the breakout in late 16 is really a perfect indication of how significant longer-term breakouts are. Again, as I said earlier, that's where you not only get short covering in some short-term, long side trading, but that's where you get longer-term fundamental investors to start paying attention to the technicals. And in this particular case, it broke out to new highs, so there's no resistance. But the important thing is just that when you get these intermediate term breakouts, your upside counts have a higher probability of being reached and exceeded, which is what happened when SunTrust ran up to 60, and now we have nearly a 10-month consolidation and breakout. So again, the slide is, I wanted people to see how important long-term breakouts are. Oh, they work over and over again, and then if they can be buttressed with positive Chaikin credentials and a positive power gauge rating, then you can just have a higher degree of confidence in buying the short-term pullback.
Now, John, I noticed that Chaikin money flow is negative here, so that suggests to me that we may get a pullback to test that breakout level, and at that point, I think you'd probably be more comfortable buying it if it pulled back to the breakout level at around 61.
Yes, exactly. Also, the money flow gauge is an oscillator, so occasionally this type of situation can happen with big price moves because the oscillator can't catch up with price, and you're also dropping off very positive readings from 20 days ago. So I wouldn't be as concerned about the negative money flow at this point as I normally would be if it was accompanied by weak relative strength and a neutral or negative power gauge.
But in any event, a pullback is in order here, wouldn't you say?
Yes. Yeah, I wouldn't chase them up here.
So now let's look at the energy sector, and I've spotted the pattern, but John speaks to this better than I do. So John, why don't you talk about what's going on in the energy sector going back to February, and then what you're seeing now here?
Well, we'll see in a future slide that the lows in August and the rally in September, October was really a function of oil rallying, and it took the energy sector up through its long-term moving average and prior high from July, which was very bullish. And then we had two retests of the long-term moving average, which matched roughly 25% retracement levels, and that's another positive. And you can see how aggressive money flow was on the break above that long-term moving average, and that to us is really the key. When we see that, then we know we're going to pull back after we get overbought, and we're above the upper bands. But we know that we can have a higher degree of confidence that that pullback to the lower band will hold near there and present a buying opportunity once we get something like we saw above that first arrow, which was a reversal day.
So here's what John was talking about, and this chart looks pretty clear cut to me, John.
Yeah, I mean, it's a little hard to see on a 7-year chart, but back in October, that's when oil broke out, and that's when the energy stocks really started to not only improve in price, but that's where money flow started to accelerate, and some of the power gauges started to turn neutral, plus, and positive, and that's what that's what we look for when we're trying to estimate some down and out sectors starting to turn around. You can't just follow price. You have to make sure the conviction of institutions is behind it, and that is where you see positive money flow. You see estimate ratings start to increase. You start to see insider selling start to decrease, and a lot of other positive movement in those 20 factors, and that's what gets you the power gauge turning green.
So when I see that, I'm looking for the stocks that have been strong even before the reversal, and one of them in the large cap space is Valero Energy. It's a refiner. They're also a retailer, and look at the money flow that's been building up since September. So I want to follow that buy signal. I don't want to buy it at the upper band. I want to buy it on a pullback. This is our relative strength buy signal. This happens when a stock that's been outperforming the market, here's our relative strength indicator, pulls back under its 21-day average and then rises back above it. It's a really simple signal. It came right after a positive earnings surprise, and the stock has moved up nicely from 76 to 86. So I always like to go with the leaders. Playing the laggards is something that cost me a lot of money for the first 20 years of my career. I've given that up. So I'm a big fan of Valero. Interestingly, when I look back at last year's view into 2017. At the end of the webinar, Valero was one of the 3 stocks on my buy watch list, with the stock trading around 66. It took some time to get going, but look what happened when the price of energy broke out, even before Valero was breaking out to new highs. Now here's a stock that John likes, with a different pattern.
Yeah, I mean, it's not really that much different. It's a 6-month base with a base breakout. We call that a cup and handle pattern for obvious reasons. So for those who like to be a little bit more daring and want to catch a move potentially a little earlier, obviously you're always wondering whether the breakout is legitimate and whether the pullback is healthy, because you're trying to determine whether you're going to get the next intermediate move up. And in this particular case, money flow remained positive on the pullback to the breakout level, which is constructive. The oscillator became oversold to help it hold at that breakout level. Relative strength, it could be a little stronger, but not during a breakout, and it's obviously much different than it was for the preceding 10 months, which is an indication of a more intermediate term swing. And of course, the power gauge. This is a perfect setup for us. You have a clearly defined pattern. You have a breakout that's confirmed by money flow and a positive power gauge, and those are the type of pullbacks we're willing to take a chance on.
And of course, these are 2 of the 7 large cap energy stocks in the S&P 500, the XLE, with bullish power gauge ratings. So that's where we want to do our exploring, our hunting. Now, what you also want to do is avoid bottom fishing in stocks like Schlumberger, which is also in the XLE, because that still has a bearish rating. And it's really premature until something improves, whether either it's relative strength, money flow, and or the power gauge, to be bottom fishing in a stock like Schlumberger, in my opinion. So focus on the leaders, Valero, stocks with the good patterns, Devon, and still avoid stocks like Schlumberger, and you put the odds in your favor. Now, we also talked about a focus on industry groups. Just going to look at 2 examples here. On the left, bullish industry groups based on the power bar. Major banks on top, integrated oil, those are the refiners we're talking about, and investment brokers and managers, bullish. 41 stocks in that industry group with bullish ratings, only 2 with bearish ratings. And then on the bearish side, consumer staples have been terrible all year, and we'll show you an example there. So here's the stock in the investment banking and investment management group, T. Rowe Price. I think most of you are familiar with their mutual funds. When I see a group that's strong based on the power bar, where the relative strength is positive, I'm looking for the best stocks in that group, and I'm looking for signals for entry points. So here's a wonderful money flow buy signal on T. Rowe Price. All of these signals are on our website, 6 pairs of buy and sell signals. Whether you're a visitor or a member of Chaikin Analytics community, you can see the explanations behind these signals. And of course, T. Rowe Price, after that signal, moved up from about 91 to 102. And that's what you're looking for. You want to buy the dips. And I think that's going to be an important theme in 2018, because you will get more market pullbacks. This all happened on a very minor pullback in the stock itself. Now, on the downside, in my weekly market insights, I highlight 3 strong and 3 weak industry groups using that same power bar analysis. Then I find 3 strong and weak stocks in each group. In the consumer miscellaneous staples, a little over a month ago, October 22nd, I singled out Newell Brands, Kimberly-Clark, and Service Corp. Newell was 40, and a couple of days later, it just triggered a sell signal in our work. A couple of days later, about a week later, it reported a negative earnings surprise, and on the left, on our intraday chart, you see that it gapped down 26% that day. That's what avoiding stocks in weak industry groups and sectors can do for you. It takes you out of harm's way. You sleep better at night. You're not wondering if the stock's making a bottom. You're not guessing. You're allocating your money to stocks where the odds are in your favor. And this stock has continued lower. Just gave another sell signal here. And it's a stock you want to avoid because there's no sign that this stock is turning around anytime soon. So that all plays into the notion of good defense, because you have to protect your capital. In 2017, as we keep saying, no pullbacks of more than 2.5%. So all you had to do was be in the right sectors and industry groups. But playing good defense is really a function of what stocks you don't own. Herb Greenberg, who's on CNBC a lot, writes for Street.com, wrote a column in January 2014 titled, "It's the stocks you don't own that matter." That's really what we've been talking about when we say avoid weak industry groups. It's knowing what stocks not to buy, because you can improve your performance if you eliminate bearish rated stocks from your investment portfolio, your IRA, and you take them off your bullish radar screen if you're trading and convert them into put candidates, doing what we call turning lemons into lemonade. And you can also use put options to protect your portfolio, to play good defense, as we saw in the beginning. And please, please, please don't bottom fish. It's the most expensive sport in America, and I'm going to show you an example of that, that you should never forget. So here's an example of a stock that you didn't want to own in 2017. TripAdvisor competes with Expedia and Priceline. It's been in a downtrend. It gave a lovely sell signal ahead of a bearish earnings surprise when the stock dropped over 15% back here in late October, early November. And it just gave another sell signal coming into today's action, down 1% earlier in the day. Here's an example of why you don't want to bottom fish. Diamond Offshore, which was a leader in the offshore drilling equipment manufacturing business, power gauge turned bearish at actually $60 back in January of 2013. This chart ends in 2014. In that period, Diamond Offshore dropped from 60 to 30. Along the way, there were many analysts on CNBC saying it's a bargain here, it's time to step in, bottom fish. And so this chart, which ends in 2014, shows the stock down 50%, potentially very attractive buy if you like the company. Now let's bring the chart up to date, and you see that the actual bottom in the stock was $10, and the power gauge stayed bearish almost that whole way. So if you thought the stock was cheap at 30 and you stepped in, you were going to lose 66% of your money and an awful lot of sleep along the way. Bottom fishing is the most expensive sport in America. Now the stock is broken out again, positive money flow, it's outperforming the market. It's still got a neutral rating. I'm going to pass on this one. It's looking better than Schlumberger in the same industry group, but imagine being able to avoid a drop from 60 to 10 and also being discouraged from bottom fishing at 30 when it was down 50% over the course of 12 months. This is how a disciplined approach can help you, and Chaikin is nothing if not a disciplined approach that combines fundamentals and technicals. So we'd like to show you our two favorite patterns and then end the webinar with John's watch list and my watch list for the first quarter. We have a pattern we call classic Chaikin bulls. Applied Materials has been our poster child for a year. Power gauge rating is at the bottom. That has to be bullish. We want the stock to be outperforming the market and have strong Chaikin money flow. Just three things you need to know, and then if you get a series of positive earnings surprises, that gives you your upside momentum most of the time. So this was a classic bull. There were plenty of buying opportunities, relative strength buys that typically last 4 to 8 weeks, 70% accurate in our back testing. And you had another positive earnings surprise where the stock spiked up to 60, started the year at 30, semiconductor equipment manufacturer, and then you got the tech sell-off. And now the stock has broken its long-term trend line, just as it did back here in July and then again in August. So we'll have to wait and see about whether there's a good buying opportunity. It's still outperforming the market. So if it goes back above its 21-day average, we might get another relative strength buy signal. But this is and has been a poster child for a classic Chaikin bull up until the last week and a half. Now, classic Chaikin bear, just the opposite. Power gauge rating is bearish, meaning the fundamentals are negatively positioned, underperforming the market. Chaikin money flow is red, not green, telling you that the institutions are selling the stock. This is Under Armour, darling of the hedge funds, hot stock, signing up Steph Curry to big $200 million sneaker contracts to try and compete with Nike, and not seeing the impending threat from Adidas in Germany. Stock saw the power gauge rating turn bearish off the charts, to use a Jim Cramer expression, $40. Series of negative earnings surprises. The power gauges continued bearish. It looked like it was making a triple bottom here at 16. That turned out to be a false breakout because it broke that. Then it looked to be making a bottom again here. And yet again, a negative earnings surprise pushed the stock from 16 all the way down to 11. So bottom fishing does not pay. For every stock where you're lucky enough to pick the bottom, there are 5 like Under Armour or Diamond Offshore that destroy your portfolio and cause you to lose confidence, sleep, and money. So everything we've been talking about is really what we call the ideal setup. Power gauge rating, relative strength, money flow, industry group. We call that the ideal setup. Warren Buffett calls it the fat pitch, because he's famously said that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. That's why Ted Williams was his idol in life, because the last baseball player to bat 400 had a very narrow strike zone. He only swung at a pitch that he knew he could drive. And so the missing ingredient, once you've found the ideal setup, are the signals that we've been looking at. 6 pairs of buy and sell signals, but there's got to be a way to find them. We have a screener to help you find the classic bulls and bears. We have a dashboard alert. This is our iPad app. On August 10th rather, this year for a webinar, my dashboard alerts showed me a buy signal in Boeing at 234, oversold buy, and a relative strength sell in Bed Bath & Beyond. So let's see how they worked out. That first yellow arrow is the buy signal. A lot of people have a hard time pulling the trigger after a stock has spiked up and then gone sideways. It's still near its high. The discipline methodology is what you need to follow. It encourages you to follow those signals because they're profitable more than 60% of the time. And so you had one here at 234, you had another one at about 255, and the stock, as you see, has traded up above 260. So very profitable to follow these signals. And on the downside, Bed Bath & Beyond, which just yesterday saw its power gauge rating finally turn bullish, gave us a series of relative strength sell signals. These two came right ahead of an earnings report, which was a negative earnings surprise. And then the one in the middle was the one that was on my watch list. All of them worked. Power gauge, relative strength, money flow, very bearish. Retail has turned around, and the analysts are getting more bullish on retail stocks, raising their estimates. So we've got a bullish power gauge rating. I'm going to wait for the relative strength to turn bullish on Bed Bath & Beyond before I even consider buying it. The next earnings report you see up here is December 20th. Analysts are still cutting their estimates, so we don't really have any confidence. There are other retail stocks like Kohl's, Michael Kors, Ralph Lauren that are better because they have bullish power gauge ratings. So follow the signals, because trading on a discipline is better than trading on your emotions, and you're more likely to pull the trigger and get the benefits of these signals if you're following a disciplined methodology. So I promised you that we would end the webinar with the stocks that John and I are watching heading into the quarter. I'll just comment on mine very briefly. Biogen was my bullish stock of the week in Market Insights. I think there's going to be group rotation into biotech. Michael Kors, 2 positive earnings surprises in the apparel sector. They made a great acquisition of Jimmy Choo and Valero on a pullback. On the short side, Charter, which is in the media group, cable stocks have been hurting. TripAdvisor we looked at, and as long as Tesla stays under its long-term trend line, I'm looking for opportunities to go short. Now, John, you might just want to briefly cover your long and short list that we put together.
Well, the longs, we went over DVN and STI. Obviously, they have positive power gauges. They have good chart patterns. They've broken to new highs. We're just waiting for constructive pullbacks on positive money flow. And on the short side, all these stocks have very negative power gauges. They're in intermediate downtrends. They're below their long-term moving averages. And many are just getting to the early stages of overbought where we'd like to put on some shorts.
So that's our list for the first quarter of 2018. Everything you've looked at is in Chaikin Analytics for iPad and desktop. We were fortunate enough to win the Benziga FinTech Award for Best Stock Ideas Platform in May. That's a testimony to the 25 people here in Philadelphia who work with our members every day to try and improve their discipline and their trading and their knowledge of the system. So Chaikin Analytics incorporates this highly predictive 20-factor model that looks at the factors that successful institutional investors look at every day, and also our stock discovery engine, which we didn't get to in the webinar. When you subscribe to Chaikin Analytics, you have the ability to enter a symbol into the stock discovery engine and come back with stocks that are similar to that stock. It functions the same way Spotify finds you music or Netflix finds you movies. In this example, way back 6 months ago, put in Axcelis, which is a small cap semiconductor stock. Put in a small cap semiconductor stock. I think it was Exelon, and came back with Axcelis at 21.73, which went up as high as 36. So that's what we won the Benziga FinTech Award for Best Ideas Platform, and it's in Chaikin Analytics. So when you subscribe, you get the benefit of the stock discovery engine and the power gauge rating. Now, additionally, we have the screener. You saw that when we were screening for stocks with a 30% tax rate, and the options play module that found that wonderful way to hedge a portfolio in either the QQQs or the SPY. So Chaikin Analytics for iPad and desktop is normally $2,195 for an annual subscription. Go to chaikinanalytics.com/New Year, take advantage of everything you've seen. But as a webinar special, we'd like to take this opportunity to reduce the price by $200 to $19.95. chaikinanalytics.com/New Year. This offer expires on Friday at midnight. Or you can contact sales at chaikinanalytics.com or call the number on your screen. Now, in addition, you get these bonuses: the intraday chart, our earnings alerts, and the detail around each earnings report, my weekly market insights with the bullish or bearish stock of the week, and John Schlitz's daily morning insights. And we got this testimonial. We've kept this webinar relatively testimonial free, but this one really sums up what someone was able to accomplish from 235 to 1,205,000 in 7 months. I've been trading stock options for many years with not much success. On January 4th of 17, I found your system. I started the year with 235,000. As of today, which was July 30th, my net liquidation value is $1.2 million. I would not have been able to do this without your system. That number has grown dramatically from $1.2 million to a much higher figure prior to the tech sell-off. So Ken H. achieved these results by taking advantage of our one-on-one coaching, because as a Chaikin subscriber, you get small group tutorials, unlimited coaching. John Schlitz is on every Monday after the close with Joe Bacella talking about different themes and how to use Chaikin, and you get as much one-on-one coaching as you need to learn what the system is all about and help apply it to your strategies. And of course, you get John Schlitz's daily morning insights, which are invaluable. So I did a live event for Jim Cramer in New York. This was a paid event 3 weeks ago. And those people saw a presentation very similar to the one that we made today. And when I was talking about the 20 factors in the power gauge, Jim Cramer live tweeted, Chaikin Analytics model is the best, used it at my old hedge fund. So real endorsement from one of the best stock pickers that I know. Now, your next steps to success in 2018. Reserve your free subscriber onboarding session tonight. Start getting our daily and weekly market insights, sign up for personal coaching sessions, and begin to apply the Chaikin methodology to grow your nest egg. Whether you're a trader or an investor, it's all about how much money will you have to spend on things like vacations and, most importantly, for your retirement. So to encourage you to take these next steps, I'd like to give you a fast action bonus. If you subscribe by midnight tonight, we'll take an additional $200 off, total saving of $400, reducing the annual subscription cost of Chaikin Analytics to only $1,795. ChaikinAnalytics.com. Joe Bacella is probably posting that into the chat box. And with that, I'd like to thank my colleague, John Schlitz, who had a really busy day writing one of our new newsletter products and then contributing to the webinar. So thank you, John. It's always a pleasure, and you add so much to my knowledge of Chaikin every time I hear you speak.
It's my pleasure, Mark.
So Joe, why don't you take it over and wrap up the webinar?
Excellent. Well, gentlemen, thanks so much for your time. Again, to reiterate Marc's offer, you see on your screen here, that's $17.95 for a full year to Chaikin Analytics. As Marc mentioned, I did post the link right within the chat room, so you're welcome to access the program right there. Again, you can just go right to ChaikinAnalytics.com/new year. The discount code will automatically be applied. We are available tomorrow for another onboard session. This is perfect for everybody here. Great way to learn Chaikin Analytics and get right up to speed. We're going to be showing you all the ins and outs, how to get started, show you how to really understand our analysis, and give you an idea for where your next trading or longer term position might be. So we'd love to have you join us there. And of course, on Monday of next week, we'll be doing another open forum with John Schlitz and myself. So we'd love to have you join us. But first things first, make sure to take advantage of Marc's discount here, $17.95 for a full year to Chaikin Analytics. You can give us a call at 877-978-6257. Until then, have a wonderful evening. Keep an eye out for the recording tomorrow. But until then, again, make sure to take advantage of this offer before midnight tonight. And we will see you on tomorrow's onboard session. Thanks.